All right, good morning, everybody. Good morning, good morning, good morning. We're back at it. Season two's first video. This is going to be more of a concept video. So basically what we're talking about is dollar cost average investing or lump sum investing. This is a question that I'm getting from a lot of the folks that have already started this process over the past few months. They're working on that emergency fund. Some of them have some funds set aside, and they now are starting this process. Or some folks have already had some money set aside that they want to go ahead and start investing. And they're like, okay, well, what's the best way to do this? And the first question I'll get is, okay, well, let's say a person has $5,000 and they go, okay, all right, so I know that I want to invest this $5,000. How do I do it? What's the best way to do it? And usually that question comes down to, there are really two types of ways to invest money, really, right? It is doing it a little bit over time. Like say every week, if you get paid every week, every 2 weeks, you do it that way. Or if you've already had money set aside, you have funds, you've been, managing your money well over years, and at the beginning of the year, you want to do a certain amount. So no matter what, you just put that certain amount down. The answer is really, in the grand scheme of things, it doesn't matter. But I'm going to give the technical analysis behind it and then a bit of the behavioral analysis as to why I'm going to tell most people to use dollar cost average over lump sum, especially for people that are just starting to invest. So let's get into it. What is dollar cost average investing? All right. So basically, let's say, for example, you're buying a stock and the price of that stock is $100 per share, right? Now, over the course of a year, the price of that stock could go up, which is what you would want it to do if you're buying it, right, and you own it, or it could go down. But also, most likely, throughout the course of the year, it's going to go up 1 month, down another month, up another month, down another month, up another month, down another month, up another month. But did you ultimately see where my finger ended for where my finger started? So throughout the course of the year, it's going to go up some, down some, up some, down some, up some, down some, up some, down some, up some. But do you see where my finger stops? So within that time frame, the price is going to vary. But the end point is the price is still going to be ultimately higher here than here at the beginning of the year. Again, generally speaking, all right, not every price of a company goes up or down or whatever, but I'm talking about over the long term. If we're talking about the Index 500, I've told you that over the long term, it's ended here. It's here, and it started here. All right. So when you're talking about dollar cost average investing, throughout the course of the year, you're buying the shares at different prices. Okay. But the main reason I tell people or I recommend dollar cost average is when you see the price do this or when it does this, some people can't stomach or they can't deal with that bit of a drop. Or if it's new to them, it's going to make you anxious to see a drop. So let's say, for example, you're doing lump sum investing, which is basically if you wanted to invest $5,000 at the beginning of the year, you put in the $5,000 January 1st and you're going to ride with it to the end. Now, what's going to happen to a new investor is if on January 1st they put in $5,000 and then March 1st comes, and we're thinking if it's 2020, March 1st comes, now COVID is out. Everybody's afraid. The value of that $5,000, if everybody runs to take money out of the markets, the value of that $5,000 that they put in drops to $2,500. Now, if you're a new investor, if you see that, what's your natural response going to be? And this is the new investor, not the seasoned investor that's watching this video that understands that's a buying opportunity. I'm talking about the new investor who's just now getting started, right? I'm going to tell you because I was there too. I'm going to tell you what's going to happen. You're going to get anxious, you're going to get nervous, and the likelihood of you doing something irrational like taking the money out is more likely to occur for a new investor than a seasoned one. So even though the lump sum investing strategy is better for the long term because of what? You're getting your money in sooner. So remember what I tell you, the sooner you get your money in, the longer time it has to compound. So the sooner you start, the more upside you have with compounding. So that's why over the long term, it is better to do lump sum. But again, I'm talking to new first-time investors. So with that being the case, if you can't, and most of them can't stomach that risk of seeing it drop, then anxiety is a big factor in how people behave. That's why I say behavioral. So again, if you're not comfortable with seeing the value of your portfolio drop, as most new investors will, I wouldn't recommend doing a lump sum investment strategy in the beginning. I'd rather you get used to putting in money so I would rather say, you know what? Take that same 5,000 and every week invest 500, or every month invest 500, right? So that you can see what's going to happen with it as the market goes up and goes down. And on the flip side, if you put in 500 and there's a big drop that occurs, right? Now that 500 might go to $250, but that doesn't have the same negative impact on your psyche as potentially seeing 5,000 go to 2,500. So I hope you're following me here, because this is a concept video. This is a concept. This isn't a concrete numbers video. This is about behavior, feeling, anxiety that's hard to quantify. Now, myself, at this point, being a seasoned investor, you become more comfortable with risk over time. So to me, I'm going to get my money in as soon as I can, right? Because I know I'm investing for the long term, not the short term. So it doesn't matter what happens within the short term. I know ultimately the price is going to be here today, and most likely 5-10 years from now, the price is going to be here, barring some significant collapse. So I'm going to get my money in sooner. But that's me. I'm comfortable with the risk. I know it. It doesn't affect me viscerally if there's a big drop that happens. Instead, no, if I have any other money that I haven't already invested, I'm going to put that money into it because I know that money bought at a cheaper price is going to be worth more. So to answer the question, right? Because I used to say my thought process was, I'm not going to tell people exactly what to do. I want them to make their own decisions like my uncle did for me. But most people aren't at that level. So I'm going to basically walk sort of hand in hand. So I'm going to recommend dollar cost average investing in an index 500 fund. No matter what the amount is, start with a certain amount and buy over time. Because this is another benefit of the dollar cost average investing. Right? So let's go back to 2020 again. You want to invest $5,000 for the year, something to that effect. You want to do $500 a month. And you've picked out a stock, or you picked out the mutual fund you want to buy, and you're going to start January 1st. So you buy for $500. February comes, you buy for $500, right? March comes, COVID is here. Now the price of that mutual fund, instead of it being $100 per share, the price of it is $50 per share because everyone got afraid, take the money out of the stock market, the value dropped. So now the price of that mutual fund is now $50 per share. Guess what? Keep buying. Because over the long term, it's ultimately going to be here. So that little small period of time where it's now $50 instead of $100, you're buying it at a discount. So now that $500 that you purchased for in March, at the shares being $50 per share rather than $100 per share, you now just experience a greater buying power. Or to put it in another term, you basically bought it on sale. Because ultimately the value of it isn't at that $50 at that point in time. The true value of it is what it was before the big scare occurred. I know this may not be, this might be a bit much. But digest the video, review it, really trying to understand what I say. But at the end of it, I'm telling you exactly what to do. Dollar cost average is the way for new investors because it brings down anxiety, which reduces the risk of you making irrational decisions. So dollar cost average is the answer for the seasoned investor that's comfortable with seeing their portfolio value drop. If a drop in the markets occur, lump sum investing is the answer for you. So that being said, that was the concept video. The next video is going to be a fun video. We're going to get to some fun stuff with the next video. So until then, start with the dollar cost average strategy and go from there. The game is free. The game is free. But the discipline is sold separately. Peace.